JM Financial Mutual Funds Fixed Income Outlook. In this short video, we would take a look at how different global and domestic factors behaved during the month gone by. This would be followed by our view on the domestic debt markets, which could in turn impact the positioning of our schemes. After 10 consecutive rate hikes, the US FOMC decided to pause and maintain a status quo on federal fund rate. They have, however, indicated 2 more rate hikes in calendar year 2023. US bond yields hardened across the curve during the month, predominantly due to the hawkish comments by Federal Reserve. There was an increase in the inversion in the 2 years to 10-year yield curve to 105 basis points as on 30th June 2023 against 76 basis points as on 31st May 2023. In the Monetary Policy Committee meeting held on June 8, 2023, the RBI MPC unanimously decided to keep the policy repo rate unchanged at 6.50%. However, the RBI government stated headline inflation still remains above the target and being within the tolerance band is not enough. Bond yields hardened during the month, largely tracking the movement in US Treasury yields and firm comments by RBI on achieving 4% inflation on a sustainable basis. The 10-year GSEC traded in a band of 6.98 to 7.12% and closed at 7.12% in June 2023 as compared to 6.99% in May 2023. Headline CPI inflation for May 2023 printed at 4.25%, lower than the previous month's reading of 4.70% on a year-on-year basis. CPI inflation remained below 6% for the third consecutive month. Core inflation inched lower to 5.02% in May 2023 compared to 5.19% in the previous month, aided by favorable base and softer price increases across all components. Liquidity conditions remained tight, especially during the latter half of the month, predominantly due to the outflows related to advance tax and GST. To alleviate some of the pressure, the RBI conducted variable rate repo auction worth Rs 750 billion on June 19, 2023. Daily average borrowing through MSF window climbed to Rs 135 billion in June 2023 compared to 120 billion in the previous month. Average systemic liquidity surplus stood at Rs 1.28 trillion in June 2023 as compared to 730 billion in May 2023. Credit growth remained stable at 15.4%, unchanged from the previous month. Credit growth was led by services, personal loans, agriculture, and industry in that order, with year-on-year growth of 21.4%, 19.2%, 16%, and 6% respectively as on May 2023. Deposit growth stood at 12.1% as on June 16, 2023, with a marginal uptick over the previous month. In the US, although inflation has fallen sequentially, it still remains way beyond Fed's target of 2%. The growth and employment numbers are giving mixed signals. Market remains cautious on hawkish comments by the Federal Reserve with a possibility of 2 more rate hikes in the current calendar year. As a result, the US bonds have reacted, which is indicated by further inversion in the 2 years to 10 years bond. A possible reversal in monetary policy in Japan can pose a risk for yields and currency globally. As far as China is concerned, a weaker than expected growth post-COVID has prompted the Chinese central bank to cut rates. The lack of Chinese demand is also reflected in oil prices being range-bound despite OPEC cutting supply. While Europe is going through a slowdown, inflation remains stubborn, especially in UK, prompting hawkish policy actions by central banks. RBI remains optimistic about domestic growth backed by resilient domestic demand, heavy capex push by the government, and improving private investments. However, factors including uncertainty surrounding the monsoon, improving but sluggish rural demand, geopolitical tensions, and weak external demand can pose downside risks. Domestic inflation seems to be in control as of now. However, upside risks to inflation persist, especially due to uncertain monsoon conditions. Trajectory of domestic interest rates would be dependent on global developments as well as incoming macroeconomic data coupled with demand-supply dynamics.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.